Now guys, before we move on to discussing the macro implications of front-end interest rates, we need to have a chat about futures, front-end futures. And here in particular, I want to draw your attention to the SOFR future market. So now remember that what we discussed in the US is that there are basically three rates, two that I represented in this chart, so OIS, proxy for future Fed funds rate, and treasury yields. But there is also a very, very important market, which is the repo market, which is represented, as I anticipated, by SOFR rate. So now, SOFR is effectively a newly created benchmark in the US that basically tracks and assembles together repo rates, prevailing repo rates in the US. It's a very, very, very close proxy for risk-free deposit rates, short-term interest rates in the US. The good thing is that there is a very liquid market of SOFR futures that can help you follow where the market is pricing these risk-free interest rates in the future. And now we're going to have a quick discussion about SOFR futures work. But again, there's going to be a set of different slides where I'm going to guide you through free sources that are in the Macro Compass offering, the volatility adjusted market dashboard in particular, and Bloomberg sources on where to find and track all the indicators that we discussed in this lesson. SOFR futures are very useful and very intuitive to track because they provide you with a live market implied expectation for where risk-free rates will be in the future. How a SOFR future works is that it's quoted in price points, and let's say the price points are quoted as 100 minus the future risk-free rate, and that is the price of the future. So if a SOFR future is trading at 97, that means that for that particular date, the future priced in risk-free rate is very close to 3%. 100 minus 3 would equal 97. This rate here would effectively be your market implied future expectation for where risk-free rates are going to be at the date of the SOFR future. A quick example of how this works here. I gave you the strip of SOFR futures between July 23 at the day of recording and December 24. So see how they're priced. July 23 is priced at 94.68. So if we follow this formula, this will be 100 minus, so 94.68 would basically be equal to 100 minus the future market implied SOFR rate. And the future market implied SOFR rate indeed is 100 minus 95.67 here, which is 5.33. So how this is useful is that Fed funds rate at the date of recording are effectively 508. This is the effective Fed fund rate, 508. Basically, the July contract is telling us that a full 25 basis point hike is effectively fully priced in. If we move forward and we want to know by December what the market is pricing in terms of risk-free rates in the US, we see that the SOFR future says 94.685. Again, using the formula, 94.685 equal 100 minus the implied SOFR rate. The implied SOFR rate is therefore 5.32. So that means that the market is expecting the Fed on a net basis to do nothing basically between July and December. And so on and so forth, even for longer maturity SOFR futures, they go all the way to 2027, 2028. So you have a live market implied expectation in front of you for where central bank rates will be at any determined point in the future. Front-end futures, SOFR futures are a very convenient, important way to track what is the market expectation for future risk-free interest rates. So something else to add to your arsenal of tracking OIS rates, of tracking T-bill yields, of tracking Euribor where available, of tracking short-end credit yield where available. Another layer to add to your arsenal is front-end futures, in particular SOFR, which is very important in the US. Always remember to track the differences as well between these indicators to get an idea of whether the monetary plumbing is working or not. So now that we have covered the more technical aspects of all the different many instruments that we have at the front end, it's time to discuss the macro implications of looking at the front end and front end bond yields. So if you remember, our macro approach at looking at bonds in general throughout the curve basically described bond yields as the sum of growth expectations, inflation expectation, and term premia. When you look at the front end and front end bond yields through a macro lens, instead you are looking at cyclical growth and cyclical growth expectations, cyclical inflation and expectations. Term premium tends to matter less because reminder, this is the uncertainty and therefore the additional premium that investors want to be rewarded for taking long-dated interest rate risk. Because we're talking about the front end, this uncertainty and this interest rate duration risk that you want to be rewarded for is actually less. So term premium tends to matter less for the front end. It's mostly about cyclical growth and cyclical inflation expectation, but most importantly, it's about the elephant in the room, which is the central bank. Cyclical growth and cyclical inflation are effectively reflected, normally speaking, into central bank mandates, either directly or indirectly. When it comes to the Federal Reserve, the cyclical growth component of front-end bond yields is reflected into the assessment that the Federal Reserve has of the labor market. Cyclical inflation, as reflected in front-end bond yields, is also reflected in the Fed mandate through their inflation mandate. So basically, if the labor market is running hotter than the Fed wants and inflation is above their target, you will see this reflected in front-end bond yields, both from a macro perspective, so as growth is strong and inflation is strong, nominal yields should go up, but also this is reflected by the elephant in the room, the central bank, and the reaction function, which will be to tighten, so to raise interest rates, because their labor market mandate and their inflation mandate are not under control. So you can always square this. In normal times, when the central bank forward guidance and reaction function reflects indeed cyclical growth and cyclical inflation, you can always square front-end bond yields through the macro approach by looking at the expectations about the cycle in the labor market and the cycle in inflation. But if you remember, we said that not always the macro approach is enough to explain and make sense of bond yields. The front end, the central bank dominance, so their ability through strong forward guidance or through yield curve control and monetary intervention can basically distort the macro picture and have bond yields differ quite widely from fundamentals. The example I drew in the first lesson is also important to have a look at again here. In the 1940s, consumer price inflation was 10-15%, and yet the Federal Reserve basically kept the nominal rates at zero, so that short-term real interest rates were as negative as -10 or -15%. Basically, by keeping nominal interest rates at zero, the Fed ignored the short-dated cycle in inflation and inflation expectations. That's why it is extremely important to think of short-dated interest rates as we learned in the technical way in lesson 1. You can always think of any interest rate, including short-end like 2-year or 5-year, as a strip of all future overnight rate for the next 2 or 5 years, discounted back to today. That way you will be able to incorporate in your understanding of front-end bond yields what is the central bank dynamics here. If there is a dominance of the central bank reaction function, of monetary intervention by the central bank, this will be reflected in a technical approach rather than in the macro approach. So by basically looking at where the Federal Reserve intends to keep rates for the next 2 years or 5 years, you can basically extrapolate where 2-year or 5-year yields should trade today by looking at them as a future strip of all future Fed funds discounted back to today, and therefore ignoring the inflation or growth fundamentals if we are in a regime where the central bank is ignoring them and imposing their dominance and their forward guidance. So one way, again, to refresh this concept and to think about this is to look at again, a 5-year interest rate here, and how to price a 5-year interest rate. We already did this a little bit in lesson 1, but it's good to have a refresh also here with SOFR futures. Those are SOFR future implied rates. We learned how to access basically these rates before. This will help us understand, again, how you can refer to a 5-year interest rate and make sense of it looking at the technical pricing rather than at the macro indication. So basically, again, if today we're looking at front-end interest rates spot, so at the Federal Reserve we are at over 5% as we speak, but we are trying to price a 5-year interest rate, we'll see that today 5-year bond yields, what you see on the screens, are roughly 3.88%. 3.88 is much lower than today's 5.25% Fed funds rate, and that is because you can think of 5-year fixed interest rate as a strip of all future overnight Fed funds rate in the next 5 years, all discounted back to time zero. And that's how you get to the pricing, the technical pricing of this 390. As you can see, we start from 525, but the market is then pricing that in a year from now will be at 390, and then will be below that. So with the market pricing, the future path ahead for Fed funds being so markedly lower, when you discount all these rates back to time zero, you get the 5-year interest rate that you're watching on the screen. And this approach is important because if the Federal Reserve sets monetary policy away from what the fundamentals would argue, like in the 1940s, you are not going to be able to square short-term bond yields only with the macro approach. You will need this technical approach to help you out. When you want to know what are and where are the future market implied Fed funds rate or risk-free rates at future dates, remember, you can use the SOFR future contracts. And so here we would see, for example, that in a year from now, the market says that the Fed will be at roughly 4%. And that is also reflected here. If you look at the September 24, the Fed, as we speak, is priced at 4.3%. This is derived by looking at live SOFR future contracts maturing in September 2024. And so on and so forth. You can follow the strip here and have an idea of market implied rates at any point in the future simply by looking at SOFR future. It's important that you can think of front-end bond yields of a 2-year or a 5-year interest rate as a strip of whole future overnight interest rates for the next 2 years or for the next 5 years discounted back to today. And you can access the future market implied rate looking at the SOFR future strip over time. Now, time to recap again all over what we learned in this lesson that covered the front end of the bond market. So guys, the front end of the bond market can be a complex animal. There is not one front end interest rate, there are many. We have to learn to distinguish between them and what they represent. The most important rate you're interested in is the central bank rate over time. That's the purest form of risk-free rate in our monetary system. Overnight index swaps are the purest, closest representation of the term structure of future central bank rates. So you want to focus on overnight index swaps to have the cleanest idea of market pricing for future central bank rates. In the US, SOFR is an important reference that works also very well because it represents the repo rates. And as we have explained, a repo operation collateralized by safe AAA treasuries is as close as it gets to a risk-free rate too. So you can use SOFR as well in the US. Many institutions do not have access to the central bank, and that is very important to remember because they have to use the repo market, they have to use the treasury market, the German bond market to try and have a closed form of a risk-free deposit, a risk-free way to deploy their cash as they don't have access to the central bank. That means that tracking the nuances and the spread between treasuries and OIS, between Euribor and OIS in Europe, between credit instruments and OIS that are often deployed by these institutions to find a way to deploy their money overnight, can give signals about plumbing issues in the front end of the market. So remember, not all institutions, actually many institutions out there do not have access to the Federal Reserve. As they don't, they need to use other markets. The repo, the treasury market, for example. So tracking these markets as well will add the layer of complexity. So when it comes to risk-free rates, you only want to focus on the overnight index rate or on SOFR for the US. But by tracking as well, SOFR market, the repo market, the treasury market, and the spread between these instruments, NOIS, or Euribor NOIS, for example, in Europe, you can have an idea of plumbing problems that arise when institutions that don't have access to risk-free rate and use other markets to try and generate risk-free rates. When these institutions find these markets a bit harder to access, you will see that popping up in these spreads that we discussed between these money market rates. So have a look at those because they can signal plumbing problems. When it comes to macro, the front-end bond yields should normally reflect the picture for cyclical growth and cyclical inflation. I say normally because that happens, and the macro approach is therefore enough to make sense of front-end bond yields when the central bank reaction function and the central bank forward guidance are aligned with their cyclical growth and cyclical inflation mandate. Sometimes, like we have seen in the 40s, the Federal Reserve or other central banks can vastly differ in setting their monetary policy from looking at cyclical growth and cyclical inflation because maybe they have another objective. In that case, combining the macro approach and the technical approach that we discussed remains the best way to look at bond markets. Actually, it always remains the best way, macro approach and technical approach. And as we explained as well in the first lesson, you can always think of a 2-year or a 5-year interest rate as a strip of all future Fed funds for the next 2 or 5 years discounted back to today. In this lesson as well, we covered, as I said, plenty of different money market instruments, front-end instruments. So there will be a separate set of slides that walk you through different public sources, the macro compass, very detailed sources, or Bloomberg sources where to access and how to get this data so that you can apply practically what you learned in this session. This was it for today. I will see you in the next set of lessons. We're going to focus on the long end, both from a technical and a macro perspective. We're going to talk about the yield curve, and after that, we're going to focus on inflation expectation, on real yields, on credit spreads. There's a lot more to learn together.